Okay, so we have a very important video that we need to get to today because the Fed again raised rates. We knew this was coming, but what does this mean to our money? How is this going to impact us as far as how we spend money in the near future? Well, I will address that in just a minute. All I ask is if you can do two things. First off, go ahead, hit that like button for the YouTube algorithm, and make sure you stay subscribed so you never miss an update. But here's what went on today. So the Federal Reserve has decided to raise rates by another 25 basis points. This is exactly what we were expecting. This is exactly what they did. So this puts the Fed's their funds rate at 4.75 to 5%. This is the highest that it has been in the last 16 years. Now, here's the next thing. This was the big one. Is what does this mean for our peak rate? Is the Fed going to stick to that 5.25%? Well, some were speculating that this could go as high as 5.75%. Well, that's not the case. They're sticking to that 5.25%. This means we are only one rate hike away from being right where the Fed says we need to be. However, and this is where things get very interesting, we have a new CPI report that's coming out in the next 3 weeks. This is going to be a huge CPI report. And I say this for one main reason. If we continue to see high numbers, if we don't see inflation drop below probably 5.6%, then there's a chance that one more rate hike will not be enough to bring inflation down. Now, I want to address what the Federal Reserve Chairman Jerome Powell had to say today, because here's the problem. If we continue to raise rates, and I can tell you right now, raising rates by additional 25 basis points, taking us all the way to 4.75 to 5%, this is going to cause more banks to panic. Okay? So, we are likely to see additional rate hikes other than just that one. Now, when the Federal Reserve Chairman Jerome Powell was asked what impacts this banking crisis will have, he had this to say. He said, and I quote, "It's too early to say, really, whether these events have had much of an effect," but he did go on to say this, that credit standards and credit availability will be affected the longer the banking crisis continues. That's a problem. Then he went on and added this, and I quote, "I do still think, though, that there's a pathway for a soft landing. I think that pathway still exists, and, we're certainly trying to find it." So this isn't a case of the Federal Reserve knows exactly the pathway to take. This is the Federal Reserve says they are still trying to find it. There's still a pathway to a soft landing. However, they're trying to navigate through all these different twists and turns to figure out what is the best way to get there. So, this could mean, and this is why JP Morgan says now more than ever, it is likely that the US dips into a recession. As far as how long and what the severity of the recession could be, we don't know. But we're getting closer to finding out. Now, what about inflation? Well, this is what Jerome Powell had to say, and I quote, "If we need to raise rates higher, we will. I think for now, though, we see the likelihood of credit tightening. We know that that can have an effect on the macroeconomy." And he goes on to say, "Of course, we will eventually get a tight enough policy to bring inflation down to 2%. We're currently at 6%. We have 4% more to go. Here's the problem. Inflation was at 9.1%. We started raising rates. And what happened was it brought inflation down. That's great. But the reason it brought inflation down is because money got tighter. We couldn't spend. We couldn't invest. People stopped spending money on things that they didn't need. Well, here's the problem now. As we start to bring the numbers down, and we saw this with unemployment. If you remember back in 2020, and I don't know the numbers off the top of my head, but if you remember back in 2020, we had rather high unemployment numbers, okay? Let's just say, we'll just start at 6%. Well, when we were at 6%, to go from 6% down to 5%, it didn't take a whole lot. Okay? It would move very rapidly. However, to go from 5% to 4% was much more difficult. And then to go from 4% down to what are we at, 3.6%? In order to go down that much more, it was brutal. Okay? It was very tough. Because as more and more people start finding jobs, it becomes more difficult to get other people into those other jobs. That's kind of what we're going to see here. As we get closer to that 2%, there's a good chance that the economy is going to take a massive hit. Okay? But how is this going to impact your money? Well, let's talk about that. First off, not necessarily how is a recession going to impact your money, because I can tell you right now it's going to hurt. But what would this rate hike of 25 basis points do to your money? Well, if you have your money in savings accounts or CDs, well, you could make a little bit extra money. It's not going to be a lot. It's not going to be anything you can go and retire over, but you will probably see a little bit of an impact. What about people that have credit cards? Because this is the group that is going to be hit the hardest. If you have a credit card, there's a good chance you're not locked in at a certain rate. Okay? So if you have a credit card, you are likely to see your interest go up. Your interest payment is going to go up. Okay? This means higher monthly payments. This means less money is going to go towards the balance that is owed, and more money is going to be going to pay off the interest. This also translates to a longer time paying down this debt. If you're trying to get your credit cards paid off, and now we just saw interest go up, it means it's going to be even more difficult. 1 year ago, the average credit card rate was 16.4%. Do you know what it is today? If you know what your average credit card interest rate is, let me know down in the comment section below. But for most people, it now sits at over 20%. We're now about a 4% increase from 1 year ago. That's big. Now, what about those that are shopping for a home? Because I know there's a lot of people out there still looking for a home. Why? They're tired of their landlord just bumping up their payment every single 6 months because the landlord wants to make more money, or they now have to pay more in property taxes, or there's other costs associated with that property that they have to increase their rent. So, a year ago, the average 30-year fixed rate loan, or actually this wasn't a year ago, this was back in 2020, 2021, right around there, but it was about 2.75%. Now we're sitting at almost 7%. Okay? So this is really cutting into buyers' purchasing power. And this is what is making many potential home buyers simply sit on the sidelines, waiting for the right time to buy a home. Because right now, here's the problem. They want to buy a home. Home prices are starting to come down. The problem is they haven't dropped enough to make up the difference of how high rates have gone. And that's why this is turning into a massive problem. But this is not the only problem regarding homes. What if you wanted to get a home equity line of credit? Well, a year ago, a HELOC was sitting at 3.96%. Now, we're sitting at about 7.76%. That is a huge jump. Now, if you are looking at renovating a home, and I've talked to many people that were thinking about doing this, they were planning on using a home equity line of credit. Here's the problem. They cannot afford the payment if they go and get a home equity line of credit. That's a major problem. What about a car? Think about buying a car pretty soon? You want to buy one because prices are going down and you know now's the time to buy it before the prices start going back up? Well, we've actually seen this over the past couple of weeks. I started to see prices at dealerships go back up. They've been coming down at a pretty good rate, alarming rate, but a pretty good rate. And then over the past couple of weeks, started to tick up. Why? Well, one of the reasons why, and this is something that I've speculated and I've seen from experts, they're kind of speculating the same thing, is buyers or prospective buyers were looking at the prices of the cars, and they started to see, okay, if it comes to this price, I'm going to buy. Well, that's exactly what they're doing. A year ago, for a new car, for a 5-year loan, it was about 4%. Now, we're sitting about 6.5% for the same new car on a 5-year loan. Again, this is what's causing many people to spend more money because they've been in the same car for the past 5 to 10 years, want something new, and they're like, you know what, the prices are coming down, this is a good deal, I'm going to get it. Well, when you don't factor in the interest rate, that creates a major problem. Okay? Now, I do want to talk about one other problem. And this is something that I've been seeing a little bit more lately. It's something that I just started to figure out that many community members have done this. I also have a few friends that have actually done this as well. But here's what's going on, and this is creating a little bit of an issue. Over the past few years, many people were able to pay off their car loans, whether it was with a stimulus check or whatever it may be. And since then, they are now going back to the banks, again, who they paid off the loan, but now they're asking the bank to get another loan, to get a loan on the vehicle that they own outright. This is crazy, but I understand the thinking behind it, but here's the problem. Right now, cars are still very expensive. Okay, so it still seems like even if you own let's say you bought a car 5 years ago for $15,000. Chances are today that car is still worth $12,000 to $15,000. Here's the reason why this is crazy. Everything's so expensive. So you are going to go and get a loan on the vehicle that you now own, have absolutely no payments. But you're going to go get a loan on that. Let's say for $15,000. I don't know what the payment would be. Let's say the payment is $280, right? Let's just say $300. You're going to go pay $300 for that car. And again, my math could be off, but paying $300 for that car at a 6.5% interest rate. The problem with that is pretty soon the car's value is going to drop. You now owe a payment on something that is going to be technically a debt. It's not an asset. And so it's going to go down in price. But now you have to pay that. So instead of you just taking the money that you make towards the car payment, the $300 a month, and putting into savings or putting into something else, the problem is people are now pulling money out of a vehicle, sitting and parking that money into a bank account, which is giving them absolutely nothing, and it's sitting there as their rainy day fund. I get it. I understand the thinking behind this. However, it could be a little bit of a problem because now you're paying interest on money that is just sitting in an account doing absolutely nothing. So I just thought that was interesting that more people are starting to do that now. But if that is something that you are considering or it's something that you have done, I would spend a little bit more time and think about whether that is the right move to make. So that's what we know at this time. That is what the Federal Reserve has done today. As soon as we get more information from the Federal Reserve, which we probably won't get for a little bit, but as soon as we get more information and we get some of the stories coming out from banks and from financial experts as well, I will bring you those stories as soon as possible. Again, thank you guys for watching. Consider subscribing, and I'll see you guys on the next one.